Now we can turn towards and focus more on what's happening with refined products, what's happening with demand, and what does that look like going forward, especially as we get some of this sluggishness, if you will, into the end of the year. And again, before we go more in depth, please, I'd like to remind you, share, like, subscribe. Your support is appreciated. And here you can see just when we start talking about what is the 5-year, what is that 5-year, the average overall? And you can see that the average is obviously starting to drift down. The current, as we calculated, is about 12.4 million barrels a day versus what was previously 13.4. And the continued slowdown is really driven by gasoline, diesel, distillate. Gasoline will start to flatten out. We don't think it's going to go much lower, but there's really nothing to say it's going to get a big bounce, especially as we have continued cases increasing and people looking to continue quarantining after Thanksgiving, really trying to lighten up their exposure ahead of Christmas, just because we've seen people trying to see at least some family for Christmas if you skipped it for Thanksgiving, which again is just going to minimize consumer behavior, consumer activity, and keep people relatively capped. And then diesel and distillate in general is gonna have, there's some decent tailwinds, there's some big headwinds, which is going to keep things fairly flat. But as we kept saying last week and in the last few weeks, we were expecting to see some lower lows and lower highs, and that continues to be the case. Again, we're thinking that we're going to get an average much closer to about 13.2 million barrels as we go into the end of the year. Now, as we shift focus and look at distillate overall, you can see that we had a big build of about 5.2 million barrels, and there was a lot of different things impacting that. So just looking over here, just because I didn't put it up, but we have production fairly flat with, looking at the yield. But the bigger component, which is why I just wanted to highlight it, is the imports. So imports, they were down 335,000 barrels a day, but they're still elevated given what we see coming from Europe. And as we talked about last week, we one of the things that we said was imports were going to remain elevated, not like they were last week, but again, I shouldn't say last week, the week before, but they still remain elevated and will stay elevated as we have the arbitrage pretty much wide open for a solid several weeks coming from Europe, which is going to keep imports coming into the East Coast. The problem is we're getting a warm up as we head through the end of from the middle of December into the end of December, which is just going to hurt heating oil demand overall, which is going to keep those pad 1 builds fairly elevated. And then you can see on an aggregate across the board, we got, things were, the slope was coming down, we were normalizing storage, and now we have a big about face, and we have almost an equal slope to the upside. Now, just because we do have some demand factors that are going to start to heat back up, we're still going to see builds, we're still going to see imports, but it's going to be at a much slower pace on the build side, which again will just help keep at least not getting back to all-time highs, those seasonally adjusted all-time highs at the top of the cloud. Will just continue to stay within the cloud, but again, trend towards the upside. Now, this is some carryover from a week from Thanksgiving. You can see that as we were saying that we were going to continue to go to the downside. Again, we thought we wasn't going to be as dramatic, but again, it's just always timing in terms of when does the stuff move through the system. We will get a residual bounce. It's just the bounce isn't going to be as big as the drop. It'll be something that'll go closer to that 5-year average, just because as you can see that we normally get a drop down. It's following the trend that we normally have. It's just it's a exaggerated move to the downside, and then we normally get a big bounce to the upside. And the bounce for us, just because of the headwinds coming through on the heating oil side, instead of it going all the way back, it'll be something that kind of sits right around that 5-year average. And what gives us that confidence? So here, when we look at, again, 95 to 105 is our range. We're right back in the sweet spot of 103.45. We got that big bounce after Thanksgiving. You can see that it's coming in through truck availability. In terms of load availability, we got that big bounce back following the holiday season. And there's this final push into the end of the year. And as we've seen from UPS, FedEx, USPS, there's been obviously a huge move online, as we've been talking about in our econ show. And that is really going to support some of the e-commerce. And UPS has actually said they're going to have to slow some of their deliveries just because They weren't prepared for the level of the surge. And there's some dynamics which we'll talk about in the econ show that is looking at, well, what is driving that? What are some implications, not only for the holidays, but also for moving the vaccine around, because UPS does have some of those contracts to use their logistics to move the vaccine into the different areas, which is one of the big things. We did see Pfizer cut their 2020 delivery expectations. And in order to get to that normalized level, they're not expecting that normalized level based on what the states were expecting until about the middle of next year. So that's going to cause, again, some of those issues as we look at just movements. But again, e-commerce is strong. Trucking is strong. We think that now that we've recovered, it's just going to remain sideways. But again, it's going to shift and stay to the upper end of that range. Now, as we shift focus for a minute into rail traffic, one of the things that we were talking about was that we were going to see some slowdown in grains and intermodal. We got that. Not by a lot, though, and let's just take it piece by piece. So total carloads were still down versus 2019, but the trend is getting smaller and smaller. So here we were only down 1.4% from 2019, and that pickup was really driven by two big things overall. Chemicals, we did get a big increase in chemicals movement, and just looking at the way plastics are moving around, the way some of these some things are normalized and we're getting some movements. We actually think chemicals will continue to see a little bit of an increase over the next couple of weeks as we head into the end of the year and into January. And then on the other side is obviously farm products and grain will continue to be strong. We had a very strong harvest. Exports remain elevated, which we'll talk about in segment 5 of the econ show as we look at China. But at the same time, the expectation is for continuous strength. So not only are we going to get exports into the market, but we're also getting seeds moving back in. We're getting fertilizers moving back in. Again, going back to the chemical side, fertilizers will be a driver of that. So farm products, grains will remain elevated. Again, we will get some slowdowns as we head into the holiday season. And then the one thing on the metallic side, motor vehicle, non-metallic, those will remain well below 2019 levels. And then intermodal has slowed, but again, it's still elevated. It'll still stay strong, especially as we have more imports coming into the coast, as some of those bottlenecks are starting to get a little bit looser, but again, it not by much. So there's still that backlog that needs to come through the system. And we did get an increase in wholesale inventories, which again is going to start to put pressure on some of the intermodal moves. But overall, total traffic is at up 4.8% versus 2019, still down year to date, but again, slowly kind of whittling away at that. And total traffic will remain above 2019 levels into the end of the year. And again, when we got to the end of 2019, we were bearish starting July of 19 as we looked at slowing distillate demand, slowing demand overall. And part of that bearish move was this disintegration of movements into the end of 19. And now, so that just means that we do have easier comps, so we will get a nice increase. But again, these are some positives as we head into into 2021. Now, switching gears a bit to gasoline, we had builds pretty much across the board. We had a build of about 4.2 million barrels. Pad 1, Pad 2, Pad 5. Pad 3 had a little bit of a drawdown, but again, Pad 3 is going to send into Pad 1 if they have the opportunity. And we did get there's some increasing demand for gasoline in the international market, which we'll talk about, which again is going to keep some of this flow moving through. But not only is Pad 1 getting filled from the Gulf Coast, there's still additional imports coming in. We have an increase of 260,000 barrels a day in imports into the East Coast. That will continue, not so much at this level. So we will see a decline week over week, but it will still be elevated versus the year over year and the 5-year average. As you can see that, as we said last week, and as we continue going forward, we're going to continue to see builds, and we think the trend will remain up, but we normally see the trend going up. It's just the slope of the curve remains elevated in terms of storage, and just the pace remains well above that top of the cloud. So we're continuing to set new seasonally adjusted all-time highs going back the last 30 some odd years. And that's just going to trend. That trend is going to continue as driving still remains lackluster as we look out at just global demand, at U.S. demand. Now, when we look at product supplied, again, we were expecting another leg down just because when we looked at the Thanksgiving Day data coming from Descartes, from Gas Buddy, both of them had demand down about 7%. The Department of Transportation had us about 6.5%, and the EIA only had us down about 2%. So there was going to be that makeup, which we're seeing here. And now when we look at Gas Buddy, when we look at Descartes, we got a little bit of an increase. Again, not what we were hoping for, but still something, which just means that we're going to not only flatten out, but we'll have a little bit of a bounce. But again, it's just going to be a lower high, which is just going to weigh on total products, which is why some people will like to get bullish oil, but we like to look at the full supply chain. We want to look at not just oil, but also refined products, because that is going to be the inherent driver of some of this demand pull that we've seen, especially coming from Asia, which we'll talk about in segment 3. Looking at the United States movements, things remain that, again, we're bouncing off of Thanksgiving numbers, but you can see that they're still below where we started. So we had a little bit of a bump going into Thanksgiving as people prepared for some bigger feast. And now we're not getting back to where we were pre-Thanksgiving, which is why we continue to remain bearish. And the data is tracking a little bit worse as we go into the end of the year. And at this point, we have increases in cases, which is why people are going to stay home. It's getting colder. You're less likely to want to sit in mass transit or to sit in traffic and try to minimize exposures. So this is something that we think is just going to continue to be a problem as we go through the end of the year, which again is showing up in not only Google, but also Apple data. Italy, Germany, UK, US continue to be very lackluster. But as we said that we weren't going to see the levels from March and April, we were just going to kind of bottom out and then go sideways. So we weren't going to see a gap higher. We were just going to maintain below this baseline. The UK has already reopened, yet they're still down 12%. Italy activity data has gotten better. It's still down 36%. These are things, Germany, same thing. Things have gotten a little bit better, but we're still seeing this slowdown. And the way it's looking is this is going to continue well into, not only through December, but into at least the first to second week of January. And just why is that? So when we talk about, Gas Buddy data first, so according to Gas Buddy, gasoline demand last week from Sunday to Saturday rose 3.8% from Thanksgiving week, but we're still now down year over year, down now 12%. So again, still nothing great. And now as we look at this week, we don't have a great start to the week with demand down 10.2% on Sunday. And then Monday was down 8%. So we're still getting that big ratchet down, which is something that we think is going to continue. And then when we're looking at Descartes, so Gas Buddy had us up 3.8%. Descartes had us up 3.3%, so pretty close to in line. But as Descartes was saying, that we've had 7 consecutive weeks of drop, and the gain last week reflected changes from a reduced demand weekend from Thanksgiving. Again, this is why when we're looking at gasoline demand, oil demand in general within the U.S., we still don't think that we're going to get this big jump. Now, when we're looking at the daily activity indicators, France has had a nice bounce, but again, it started to level off. We were hoping we were going to continue to see a move into about 80%, but instead we really leveled off at about 70%. And we've continued to see a little bit of a worsening in Germany, Italy in terms of activity numbers. And the U.S., again, continues to stay fairly flat. As you can see, that white line is drifting closer to that 60 number. Germany, same thing. A lot of these high-frequency data points just continue to shift down, or at least are flattening out at kind of a fixed number and then trending to the downside, as we've seen with France, as we've seen with some of these others, which just gives us a pause when we're looking at, okay, well, what does industrial activity look like? What is GDP going to look like going to the end of the year? What is Q1 setting up for, which is why we talk about this in the Econ show as some of these bigger headwinds. and just looking at it a little differently on global mobility in all categories. So we're just going to look at the global Google community. So let's take the 7-day average and try to look at it across all the backdrops. So Morgan Stanley had put this together using some of that Google data numbers and trying to show some of the pain. And you can see that grocery and pharmacy remain just below 3%. So there's been a very continuous move in groceries and pharmacies, which is why when we talk about inflation, which we'll go into more depth again, and the velocity of money in the econ show this week, we keep talking about inflation because prices remain elevated on the food side, but yet, everyone's like, oh, well, inflation's down. It's like, well, yeah, because airfare, some of these other things that nobody's buying is down, but the stuff that I am buying, which is food and whatnot, and processed and unprocessed, continues to rise. And then on the other side, when we look at retail and recreation, workplace and transit, you can see that we're drifting lower, and that 7-day moving average is pulling to the downside, which is why we think that we're going to continue to see that drift. And this is on a global level. So, there's some bright spots. There's no doubt about it. And we'll talk about some of them in part 3. But on the whole, the places that are seeing the slowdowns are the ones that are consumed the most refined products, or at least a large part of the refined products. Now, China, on the other hand, is seeing a little bit of an increase. We'll talk about those economics. But India has slowed down versus October, which again is being reflected as we go through November. U.S. continues to slow, Europe continues to slow, which again is drifting us and pulling us down. And what's driving that? So when we look at net changes, clearly the U.S. Is hitting all-time highs on a lot of levels, and this is not one of them that you want to be on. And just based on the amount of testing, the amount of concern, I know when I drive past testing centers, places that were usually 1 lane are now 4, and I know it's people that are concerned after Thanksgiving, want to get some testing done ahead of maybe an extended Christmas stay at their relatives. So this is going to continue just as testing continues to increase. India, the numbers have finally been streamlined and stabilized, and you can see that it's drifting lower. But the problem is there's pockets of increases. So we're actually seeing an increase in the stringency index in India, which it's not really reflected in the cases, but we're seeing it in some of the high frequency data. But as you can see, worldwide cases remain elevated and continuing to trend at the higher end, with Europe again kind of are already moving past and turning the corner. But we still see pressure as we look at the Europe, Africa, and other areas, with actually Africa and the Middle East seeing a big increase in some of those cases. Looking at U.S. high-frequency data points, I think this is important just as we start going through a bit more detail, because the lockdown index, you can see, has shifted higher post-Thanksgiving, and it hasn't stopped. Now, again, as we've said, we don't need the government to tell us not to do something, because people are naturally adjusting the way that they're shopping, the way that they're going about their days, and it's really being driven based on those cases, based on deaths, based on new COVID cases, based on new COVID deaths, and based on ICU numbers are keeping people home. So even though the stringency index is just showing that this is the biggest enforcement we've seen since essentially since this all began, because when we look at January overall, when we look at June, we were at 73. Now we're going back to 75, and that's something that's going to continue. And then when we look at some of the other metrics, you can see that all of them are trending in the wrong direction, except the S&P 500. that number stays green, because why not? It's all priced in, or whatever you want to talk about in terms of where things go. We remain concerned about 2021. I know most aren't, but again, we think we try to show the data that's giving us some pause in terms of how quickly things can turn. Jet fuel, the draw was about 880,000 barrels, and it was really driven based on, again, that resurgence. As we said last week, we were expecting to see a bounce. It was a little bit higher than we were expecting, but again, it's nothing that is instrumental in terms of changing the narrative of fuel demand, especially as we get a big walk back of additional flights, which we'll talk about in a second. Tsa Passengers, you can see that, as we were expecting, a lower low. Again, it's just people are going to pull back. Typically, as you can see from a year ago, there's normally a decrease just as people do less as into the end of the year. People start to take the vacations. The typical travel starts to slow down on a corporate level as well as a personal level. So nothing too crazy versus year over year, but you're just seeing that, again, why we remain confident in our 550 to 850 range, and there's really nothing to shake that view, especially because we're seeing 430 fewer departures week on week, and it's, again, driven by the U.S. So we see the rejuvenation of jet fuel at the airport by the airlines, but there's no flights to really make that up. We're starting to see some normalization in Europe, a little bit of an increase in China. The Chinese increases will continue as there's a preparation for Lunar New Year. More flights will be added. There is an expectation for travel. And that's something that we'll talk about as we get closer to Lunar New Year in China. But we're going to continue to see departures in China increase, and we'll continue to see departures start to come off in the U.S., not at that pace. This is kind of the final push from Thanksgiving. But just based on what we're seeing, it's just going to be something stable. And then Europe, just based on lockdown extensions and people not moving around, we think that Europe is going to stay fairly flat. So again, this is going to be a headwind for total jet fuel consumption. As we look at OpenTable, we're starting to find this new normal as the cold weather sets in, as we continue to see some of these pressures. Again, we're expecting to kind of hold these lows and hold these highs and just essentially go sideways at about, let's call it, 53% to down about 65% and kind of live within this new normal. As we've seen here, we're sitting between 50 to 69%, 60, almost 70% on a global level. Australia keeps putting up donuts, 0% spread, 0 new cases, 0 new ICUs. Everything that is positive in terms of kind of stemming slowing things down. Ireland, something similar. Germany has extended into January, so Germany will remain low. Mexico is seeing a lot of pressure, not just in terms of COVID, but also economic. UK, something similar, even though things have loosened as we look at December 1st at 96%, and then a big increase of almost 35%. It's because December 2nd, the national lockdown ended, but we do have pockets of lockdowns and restrictions, but at the same time, people just want to limit their exposures. U.S. is something that's going to continue. We're going to see that trend in average closer to 60% and not so much that 50% that we saw before the winter really set in. On a driving level, driving was down in New York City, and I think that speaks more towards, because when we look at MTA, you can see that MTA is starting to come back, 7 days kind of normalizing, a little bit below where we were, a little bit of a curve, but again, mass transit's fairly flat. People have been driving more, and they've been trying to avoid mass transit. So when we look at actual driving, and we're going to talk about it in this week's report, driving has actually come down, looking at tolls coming into Manhattan and just general driving in and around Manhattan, looking at toll data. And that's just, again, showing you that people are just doing less, trying to limit exposures, which is going to be important as we look at demand implications. And now that we talked about the U.S., we can in segment 3, we're going to go more broad and look at some of the issues that we see and some of the bright spots that we're seeing on a global level.